Assalamualaikum warahmatullahi wabarakatuh to Tuan Zaki and also to my fellow friends. Today we want to talk about financial accounting 2, which is accounting for trade payables, provision and contingent liabilities. Before that, let me introduce myself and my friends. My name is Anis Surya binti Muhammad Rafi. My matrix number 03D820F1070. My friends Amira binti Zakaria 03D820F1067. Fatin Nur Emilia binti Abdul Haris 03D820F1020, and the last one Nur Aina Atika binti Harun 03D820F1077. Okay, the first slide is a table of content. First, we will talk about mind map. Second, contingent liabilities, and third, contingent asset. Okay, now I will pass this presentation to my friends, Amelia.
Thank you, Anisarya. I will begin the presentation with trade payables provision, contingent liability, and assets. They have four sections: trade payables, contingent assets, provision, and also the provision. Trade payables provisions, contingent liability, and assets. Contingent assets is a possible assets happening from the past events depending on whether some uncertain future event. It also known as contingent gain inflow. Recognition of contingent assets. Contingent asset is not recognized in financial statement but no need debit or credit. Must disclosure notes to the financial statement if the inflows of economic benefits is more expected than 50%. No need to mention it in financial statement if inflow of resources is less than 5%. Not disclosed as contingent asset if the nearly confident is 100% is assets. For example, compensation. Trade payables. The advantage of credit terms. By credit, unlimited cash to rolling the business, increased sale or profit, and also it is a long-term business. By cash, limited cash to rolling the business, decreased sales if stock not move up, and it is a short-term business. The company or the person provide the goods or service by credit terms. Another term of trade payables are trade creditors or suppliers.
Trade payables, provisions, contingent liability and assets. Provisions, recognition of contingent liability. Contingent liability is not recognized in financial statement. Must disclosure notes to the financial statement the nature of event and estimates of effect in financial statement. No need to mention it in financial statement if outflow of resources in remote. A possible obligation depending on whether some uncertain future event occurs. A present obligation but payment is not probable or the amount cannot be measured reliably. Recognition as contingent liability. Certain of obligation, whether legal or contractive, that cannot be recognized as provision because does not meet all the requirements as provision. Possible obligation or probable obligation, not liability or provision. Outflow of resources as the settlement is not probable. Estimations reliable of amount cannot be made. Obligation, even legal obligation, contract, legislation, other operating law. Constructive obligation, entities action through an established pattern, published policies, specific current statement. The setting aside of income.
Okay, thank you Aina. Now I will continue about contingent liability. Contingent liability is a liability that may occur depending the outcome of an uncertain future event. A contingent liability is recorded if the contingency likely and the amount of the liability can be reasonable estimate. The liability may be disclosed in a footnote on the financial statement unless both conditions are not met. Okay, now I will pass this presentation to my friend Amira.
So let's continue about understanding contingent liabilities. Pending lawsuits and product warranty are common contingent liability example because their outcomes are uncertain. The accounting rules for reporting a contingent liability differ depending on the estimate dollar amount of the liability and likelihood of the event occurring. The accounting rules ensure that financial statement readers receive sufficient information. Important. An estimate liability is certain to occur, so an amount is always entered into the account even if the precise amount is not known at the time of data entry. Okay, next, what are the three types of contingent liabilities? General accepted accounting principle recognize three categories of contingent liabilities, namely probable, possible, and remote. Probable contingent liabilities can be reasonably estimated and has to be reflected in the financial statement. Possible contingent liabilities is likely to occur as not and need only be disclosed in the footnotes of financial statement. Remote contingent liabilities are extremely unlikely to occur and do not need to be included in financial statement. Okay, example of contingent liability. A pending lawsuit is a common contingent liability example because its outcome is unknown. However, if a company's legal department thinks that the rival firm has a strong case, which means the contingent liability is probable and they can estimate the loss, then the firm posts an entry on the balance sheet to account for the legal expenses as an accurate expenses. A warranty is another common contingent liability because the number of products written under a warranty is an unknown.
Freshie and Living Berhad was sued by its competitor for patent infringement in October 2019. Its legal advisors had determined that it is probable that Freshie and Living Berhad will lose the case and the estimated amount of damage will be 300,000. Briefly explain how the damage should be reported in the financial statement of Freshie and Living Berhad as at 21st December 2019 and in the case Freshie and Living Berhad will book the amount of 3,100 as contingent liability on its balance sheet. On the other hand, if the legal advice think that the case does not have a large probability to lose the case and occur damage, they will advise Freshie and Living Berhad not to make any provision of a contingent liability. When the probability of a contingent liability is low, then is no journal or even a disclosure of required in the books of accounts.